Welcome. What are we doing today?
Everybody, Money Mondays. Do this every Monday, 3:30 Central. We are back live here in the Disrupt Equity Studios in CNN. No, I'm kidding. We're not a news serial. But we're excited to be here. Excited to have you all. Thank you all for tuning in.
Heck yeah. Disrupt Equity boys. Ben Suttles, Mr. Ferris Booster right here. We do this every Monday at 3:30-ish. But what are we talking about today, my friend?
Talking about our apartment investing strategy. Why we buy the deals that we buy, and how do we think about them whenever we buy them.
There's a lot to think about here. So
yeah, I do most of the thinking.
I would say
here.
I want to preface today's show by saying, hey, you can skin this cat a million different ways, folks. You know, we have met people across the country that have done multifamily investing and just real estate investing in general 1,000 different ways, right? So this is just a little bit about our journey, how we were able to kind of make our way through the process and kind of get things spun up into an actual private equity company that we are now, right? So we're a couple minutes behind, so let's get right into this. What are the different types of strategies that exist? Oh my gosh. So I'd say I'm going to start off with one, right? You've got the guy or gal that just wants to be their own boss. They just want to replace their W-2 income, but they don't really want to scale a commercial real estate company, right? And then you have the people that do want to do the total opposite and build a big behemoth company that then goes out and acquires a bunch of properties. So don't think 3 to 5 properties, think 30 to 50 properties.
Some may call them masochists, such as ourselves.
Ooh. So there's pros and cons to each, right? So I'm gonna probably start with the pro of, kind of going a little bit smaller, right? You've got probably a lot more control over the process, right? But I'm also going to say a con, it's going to take you a long time to do all that, and you're going to be busting your butt doing all of the different things on your own, right? Whereas if you're to build a big real estate company, it doesn't even have to be big, but you're scaling out an actual company that has employees, and you've got asset managers, and you've got acquisitions people, and you've got marketing people. All of those people are on your team, right? So I would say the pro of that is that you've got great people around you that can go out and help you do a lot of the process, right? The con is obviously you got a lot more overhead, right? So you're gonna have to go out and buy more deals to support the overhead that you have. And I think that that's important for people to make that distinction, right? Is that, there's ultimately you're running a company. There's companies got payroll, companies got other overhead. And so you're gonna have to have enough revenue coming in, enough fees and enough, exits and takeovers that you're gonna be able to justify all that. And sometimes it's gonna take a little while. Maybe you're kind of in that chasm where you're like, okay, I can stay here in my comfort zone, 3 to 5 properties, or I could say, you know what, I'm really gonna blow it out, right? And it might take a little bit of an investment on your side to hire on those people at first, right? Money out of your own pocket. You're funding the deal before you get to enough deals in the future where you can ultimately, have that payroll supported, right?
Absolutely.
That's all?
That's
Absolutely?
All.
All right. Wow.
Ben's right. Like it's two, different strokes for different folks, right? And it's about what is a fit. Just like we tell people, find a deal that matches your investment criteria, right? As well, even with apartments as a whole, figure out what matches what you want in life. Yeah. Some people, they're nearing retirement. They're looking maybe to kind of build up some quick cash and then park their money into a deal and just sit back and relax. Some people are younger and hungry and, get the thrill of building a company, right? And I think we probably err more towards the latter. And again, there's not really a right or wrong, right? And, with each comes a lot of different kinds of responsibilities, right? We're quickly losing our hair because of all the responsibilities that it comes along.
It certainly ain't growing back anymore. But no, I think
we can fix that. We can fix that. There's surgery for that.
There is surgery for that. Was it $1 a hair or something?
Something like that.
We know some people. We're not going to name any names.
They got a deal. It was like 75 cents a hair fall.
Yeah, we're not going to name any names, but they were telling us about it. But anyway, I think Ferris brings up a good point, folks. Right? Where are you at in your life? Where are you at in your career? How much do you want to work? Right? Because I would say both strategies. If you're going to go out and try to syndicate deals, is going to be a lot of work. Right? It's just going to be different types of work. Like we spend a lot of our day mentoring, managing, guiding the team members on our team versus doing a lot of the doing, right? Still a lot of work on both sides, right? And then ultimately the buck stops with us, right? So we have a fair amount of risk. But, at the end of the day, versus doing the doing, which is what this person is doing, right? But he also brings up a third bucket, right? Maybe your strategy is, I don't want to do any of that. I want to be in real estate. I want to be in multifamily, but I don't want to have to do anything. Well, guess what? You're going to fall into that bucket of being a passive investor, right? Where you're just putting money into syndicator's deal, have them be the active investor and have them go do all the headache stuff and all the work and all the hard work and take all the risk. And your risk is only limited to the amount of money that you put into the deal, right? And so you can really fall in 3 different buckets if you want to play into this game. Right. So again, maybe drop some of your strategies in there. How did you get started? Where are you at in your career? Where do you want to go with your career? And I think it's all about jotting this stuff down, right? It's all about putting stuff up on your vision board and what your goals are, and you need to track this stuff, right? If your goal is to buy 5 deals in that year, we've talked about this on the show, right? That's a certain amount of LOIs that you're going to have to submit, right? Letter of intent, folks, for those that are just now tuning in. And upstream of that, that's going to equate to a certain amount of deals that you're going to have to underwrite. Right, a certain amount of property tours that you're going to have to take. So you're going to have to itemize whatever your strategy is, determine what your end goal is, and then back into that, right?
Do you
what's
have
the
the
plan?
capacity to do those?
Yeah,
Whether
for
it's
sure.
Money,
Right.
which is wherewithal, which is partners, or time.
Time.
Right? The thing we're struggling with right now is time. It takes literally, we have multiple deals right now going on. We need to go out and see those deals. I need to actually go tour a deal that we're also still chasing. We're running out of time. And so again, you scale out your team, you scale out your people, make sure it fits what you're looking to do.
Absolutely, right? So like a lot of this boils down to those 3 buckets, right? Time, experience, and money, right? And do you have those, and does that fit the strategy you're trying to take, right? So it kind of talked about what our strategy is and why we chose it. I think it was, me and Ferris like to do the things that are big and complicated and challenging, right? Because they're rewarding. I think in the long run, we're very competitive people. We like to, ultimately win. And I've talked about this on the show in the past, right? What do I want to win? Well, we want to win everything, right? We want to win the deals. We want to, build, the big processes and systems and strategies and take on these big challenges, because it's ultimately very fulfilling for both of us when we actually get it across the finish line, right? When you actually get it done. So, building a big commercial real estate firm was always something that I've always strived to, and I know Ferris did too. And so we were very in sync with that. But I always encourage people, whenever you're taking on partners, make sure your partner also has that same goal, right? Because if your partner is, hey, I just want to lay back and do 3 to 5 deals, and you're wanting to buy 30, guess what? You're going to have a disparity there pretty quickly, and that's going to ultimately lead to you guys breaking up, right? So, some questions that had come in before this: what are some of the biggest risks of your strategy? I think hair loss, blood pressure going up. You can maybe gain 20 or 30 pounds, but I think ultimately there's risks in everything that we do. Real estate investing is not without risk, right? You can mitigate that risk through a lot of different things: getting the right debt, having the right partners, having the right management company, having the right insurance on that. That all mitigates the risk that you take on. But ultimately, regardless if you have 3 deals or you have 30 deals, the buck stops with you. That's just how it is, right?
Yeah, and I'd add too, in terms of risk, we're kind of talking about building your business risk, but even within, by strategies, what I meant to say. We're talking about building your business strategies, but there's also the strategy of what are you doing within the business, right? So for us, we're typically looking for value add opportunities, right? Deals where we go in, we can inject capital into the deals, improve NOI, improve revenue, therefore improving NOI, right? That is our strategy. We can go in there, buy a deal at 1 cap, but get through the CapEx and basically come out the back end at a different cap rate. Now we're able to produce yield, produce returns for our investors, and move on. And so really, with that, right, what is the risk that it introduces? It introduces a couple of different risks if you're looking at it from that lens. First one is really getting accurate bids, right? CapEx, we've seen prices change quite a bit, right? So there's always that risk. There's the risk of just not being able to hit your pro forma, right? We like to buy deals where we've seen, people get those rents, so we're not the ones that are kind of trailblazing. But again, you might not be able to get it. You might think you can rent it for $1,300, and really the market's only showing you that you can get $1,200. Yeah. That's a $100 difference. That may go a long way. And last but not least, right? Since it's typically value add, you're buying typically older properties, and so again, just there's more things that can go wrong on an older asset versus a newer asset.
Yeah, no, and again, I think we're opportunistic. We bought everything from Class A down to Class C workforce housing stuff, right? I think we're more driven by the returns that we can get for our investors and making sure that we can execute on that versus sticking to one niche. But Ferris brings up a great point too, right? As part of your strategy, do you want to buy 30? Do you want to buy 30? You should really determine what you want to buy. Even upstream of that, and that's the buy box that we've always talked about, right? What do you want to buy, and what is your investors going to be interested in having you buy? Right? And even as an LP, again, you need to have a strategy. Don't just be peppering money into everybody's deal that comes across your inbox, right? You know, if you want to be in primary markets, you want to be in Class A deals, that should be the only thing that you invest in, right? You know, determine what your strategy is. And I think, you know, ultimately, if you stick to that and you feel comfortable with that strategy, then that's going to mitigate some risk too, right? All right, so moving along, how do different geographic locations impact or change your strategy? Ooh.
A couple things, right? With geographic locations, you have different price points, right? You know, doing labor is very different in different markets, right?
That's
Texas
true.
labor
That's
is
true.
typically cheaper than it is if you're in New York, for example, right? Other thing too is just your vendors, right? You know, you may have a good Rolodex of people for management, for doing your CapEx, for doing all these things in one market. It changes dramatically in different markets. So whenever we expand into new markets, we typically like to go into markets that we have contacts in, right?
Yeah.
We either have friends that own deals in the area, or we have some specific vendors that can help us grow. Now, again, your management company can usually help you identify some of those people, but what if you don't have a management company? So now you have multiple problems. And maybe last but not least, you know, different locations are susceptible to different parts of the cycle.
Agreed.
Right? And so I'd say, you know, it could be, for example, let's say you're investing in a Beaumont, right? Which is more heavy on oil, right? Not only oil, but it's got other things.
It's got
but
some
again,
oil
we've
and
done
gas
multiple deals on
components.
Beaumont, and we always knew that oil is a concern, right? If oil takes a dip, you know, there's some risk there, right? Doesn't mean that it's a lot of risk, but again, different markets have different things.
Agreed.
Let's say you're investing in Midland. I mean, that's really the right one to pick on. They are boom or bust in terms
That
of
is
oil.
definitely probably even a lot
That's a
more
much
so
better
than Beaumont, for sure.
I'm tired. I should have thought of that
No,
one first.
it's all good. You know, I mean, I think again, you know, Ferris hit it right on the head. You know, each geographic location is going to have its own, you know, things that you need to be knowing about that market, right? You know, I mean, we were having this conversation a couple weeks ago, right? You know, I mean, because we look across the country, at least in the Sun Belt, right? Each state has its own different tax, you know, way of assessing deals, right? So you need to understand that, and what does that impact as far as your acquisitions go, right? How does insurance impact it, right? You know, I mean, there's, you know, insurance in Phoenix is significantly cheaper than insurance in, say, a Beaumont, right? You know, because they're just two different markets. You obviously got hurricanes in one and not a whole lot of natural disasters in the other. So you got to take that into consideration, right? And so those will certainly play into our underwriting. But again, you know, I mean, we're opportunistic, and you know, as long as it fits that buy box and we can underwrite to the right numbers, whether it be payroll or insurance or taxes, you know, we're going to go after that, right? But you, as a, you know, somebody that's starting off, or maybe somebody that's bought a few deals, but you're trying to say, okay, hey, what do I want to do? Do I really want to scale this, or do I just want to kind of just hum along? And there's not a right or wrong answer here, folks. You still need to determine these issues and determine what is my strategy moving forward. So I'm going to say the one thing too about sticking with the 3 to 5 deals. At some point, you're going to sell those. Then you're going to have to get back in the acquisition, you know, process. And sometimes it's like riding a bike. You'll eventually get it and pick it back up, but it takes a little bit of time, right? You know, so you know, versus if you're always in the market and you're transactional, there's a little bit of benefit of that, right? So I'd say, what are the tips for the new investors in building their apartment investing strategy? And I think we've talked about this at least a little bit just a minute ago, right? You know, you need to sit down and determine what markets you want to be in.
Yeah.
What do you want to do, value add, or do you want to do a yield play, right? And
Types of deals you want to buy, who you want to buy them with, right? What partners you want to have, you know, what kind of vendors and some other things you're looking to identify as well, right? Do you have the wherewithal to get the deal done between vendors, partners, all that? Price points, right? You know, is there yield in those markets? Maybe is a good example, right? Like in New York, the returns are very different than in Atlanta, right? So
well, and I'd say, yeah, you brought up a good point, right? There's not
got
going to be a lot
plenty of good points,
There's
man.
not going to be a lot of cash flow in Manhattan, but historically, Manhattan has always gone up too, right? So you got to take that into consideration. And one of the reasons why Manhattan is as hot as it is, obviously, it's got a lot of business and it's got a booming economy, but you're on an island. There's not any more places to build, right? So versus say a Texas where you can just continue to go out and out and out. So you got to take that into consideration, right? And I think, you know, it ultimately boils down to how much money you can raise too is going to determine somewhat what your strategy is. Or maybe hey, I've got the wherewithal, I've got $5 million in the bank. And I'd say congratulations, that's a lot of liquidity, you know, but that $5 million when you're buying a $20 million deal or $25 million deal is going to go like that. So you got to take that into consideration too, is what is your wherewithal, or what is the wherewithal of how much you can potentially raise too. So you're looking at how big the deal is, what type of deal it is, what type of play it is, where it's located at, how big is it, because that's going to determine how much you're going to raise, right? All of those things as a new investor, you need to determine. And again, it goes back to the buy box. I'm going to keep pounding that into everybody's head. Don't just get into this and just start firing off offers all over the country. I've seen that happen so many times. And don't get me wrong, I kind of fell into that trap. I didn't fall into that much, but I was in Houston, but I ended up in Beaumont. So I'm like, okay, what do I do in Beaumont? Let's buy some more deals, right? Whereas if I was a little bit smarter, I probably would have stuck to the primary markets, at least back then. So you need to figure that out before you really get into this thing hot and heavy. All right. So what questions should passive investors ask their sponsorship team regarding their apartment investment strategy? I was just going to say, make sure that they align, right? If you're a passive investor and all you want to do is Class A deals and, call it Florida, then you shouldn't be talking to, a syndicator that only does workforce housing deals in Texas, right? You're wasting each other's time. They're never going to bring you a deal that you're going to want to invest in, right? I'd also say, does the timeline, so it's geographic, it's the type of class. I'd also say how long do they want to hold on to it for, right? Because we have some investors that they don't care if their money's tied up for 7 to 10 years.
Yep.
And then I have other investors that are like, I want to be out in 3 to 5. So you need to determine that too. Don't invest with a guy or gal, as a passive investor, don't invest in an active investor that's going to hold on to a deal for 10 years if you only want to have your money tied up for 3. Because I'm going to tell you folks, it's extremely hard to get bought out of these LLCs. That's the one thing that's bad about syndication is you're buying into an LLC that's then buying real estate, right? So it's very illiquid. Unless the sponsorship team or they can convince another one of the investors to buy you out, you're stuck in the deal, regardless of what happens, right?
Yeah, I completely agree. And then also, ask to talk to their investors, right? Get references, get to know what they're doing and whatnot.
Oh, in all cases, right?
Yeah, so definitely get to know the sponsor, right? Like Ben said, time horizon, what is the plan? Does it align with what you're looking for?
Yeah.
What is their track record? And talk to some of their investors. Are they people that are easy to get a hold of or not, right? All those things. You're getting in bed with this person. You want to be comfortable with them. So.
Ask questions, folks. We always tell people, yes, we got this big, long deck, and we got this long webinar. We want people to ask us questions. We're not going to get mad. We want you to approach us. We're very approachable guys, because, again, this is your hard-earned retirement funds. You are allowed to ask questions about the deal, right? And a strategy. And you're allowed to poke holes in it too. At the end of the day, you might say, hey, I don't really agree with somebody's assumptions, or I don't agree with this or that, and that's totally fine too. Not every deal is going to align with every person that we put it in front of. So I think as a passive investor, you've got that power to ask those questions and try to be a part of that process at least up front, right? So you can feel comfortable being more passive on the back end, right? So boom, we got through it.
So let's see. So if you have comments, questions, please leave them. We will answer them live. I know we did get some. So let's see. Good afternoon. Question: would a 32-unit deal in 77028 be too small to partner with on? Yes.
Yes. I would
for
say,
us, we'd need to be 100 plus units. Period.
Yeah, for sure.
So
but there's people out there, right? I would say I encourage. There's a lot of Facebook groups. There's a lot of LinkedIn groups. If you have it actually under contract and you're not trying to wholesale it, I think that there's probably people that you could potentially partner with.
Definitely.
So,
So let's see. Otherwise, we can keep going. But if you have comments, questions, please go ahead and ask them. We will answer them live.
And tell us what your strategy is, right? Maybe, hey, you've got a totally different way that you look at the market, that you approach it, whether it be as an active or a passive investor. We'd love to hear it from you. We want this to be interactive, folks. Yeah. All right.
Let's keep going. But before you do, what do we have coming up next week? We're launching something next week, right, Ben?
Oh my gosh.
We have a new fund.
We got a new fund.
So stay tuned for those that are really interested in investing.
Yep, very diversified, in some great high growth markets. We just shot the webinar. We're really, really excited about it. It is a 506C for you guys that are thinking about the SEC compliance rules. So that is the reason why Ben and Ferris are talking about it, because if it was a 506B, you'd only have to be on our email list and you've had to have a pre-existing relationship with us. You can look up those laws and rules, online. But we're really excited about that. That's going to launch next week. 508 units spread across 3 different deals in 3 different markets. One of them, actually all of them I really, really like, but one of them we're really excited about because it's our first deal in there. But stay tuned. If you're on our email list, check it out. We'll be sending that out, I think, Tuesday, Shannon,
Tuesday.
you think? Tuesday. All right. Boom. in the meantime, I wanted to go through a charity that I'm working with Mr. Eric Upchurch on, and that is the Veterans Community Project. I've talked about this on the show a couple times last, few Mondays. Check it out at bit.ly/donate to Homes for the Brave. We are raising money for homeless veterans to support the effort of building them tiny homes in different communities throughout the United States. I'm looking to raise $30,000. I'm probably about, maybe a third of the way there, and I'm going to match up to $15K, dollar for dollar, each investment. So even if you could put in $5 or $10 to help a homeless veteran get into a home, please, we love your donation. Check it out. They've got a lot of great stuff on their website too, so check out Veterans Community Project as well. Love for you to have a donation. And there at the bottom there, you can go ahead and donate. Boom. It wouldn't be a Money Monday without talking about Multifamily Investor Network Conference. And we are in Seattle.
Seattle.
So, sorry. You had me thrown there the last couple weeks.
We're excited.
We are in
officially
Seattle.
in Seattle coming up in, what is that, 3 months from now? May, June, July, 3 months from now.
Wow, all right.
So we'd love to see you all there. Should be an awesome time.
It's a great time of the year to be in Seattle too, folks. So maybe come a little bit early, stay a little bit longer, bring the family.
We're going to stay there a little bit longer. We're doing some team building events.
Whoa. He's getting crazy here. It's getting crazy. So that's going to be July 23rd in Seattle, Washington. Check it out, www.mfinvestornetwork.com. Put the coupon code DISRUPT in there at the checkout. Get your $100 off. Shanna doesn't allow us to make any money on this. We're just giving these tickets away. But as we have in the past, it's going to be a great opportunity to network, to collaborate, to hear some great panels, hear some great speakers. We're going to have some awesome people coming out there. But again, check it out, www.mfinvestornetwork.com, Multifamily Investor Network Conference. All right, what's coming up next week? Oh my gosh, it's already that time.
Getting rich from real estate in today's market.
Oh my gosh.
So at our Texas meetup coming up. So definitely check it out. It's next Thursday, disruptequity.com/HTX meetup. Would love to see you there in person.
Yeah, I'd love to have you guys out. If you're in the Houston area, check it out. Pitch 25 Beer Park down by Minute Maid Park where the Astros play, 7 p.m. Central, May 5th. Disruptequity.com/HTX meetup. Check it out. We got a lot of great people. Typically get 100, 150 people out there. We'll have some speakers, maybe a panel, a bunch of crazy stuff out there. But good food, good drinks. Look forward to seeing you guys out there next week. So, what are we talking about next week?
Before you do that, let's see if we have any more comments, questions. I guess we got one. Chris Collins says that conference is straight value. Thanks, Chris.
Thanks, buddy.
Love to see you there, Chris. It's not too far. It's over your side of the country, so.
Yeah, it's on the West Coast.
Hopefully we can see you there. We can catch up.
Yeah, no, I'd love to see you out there, man. All right, so next
going.
week, we're talking 2022 Q2 multifamily real estate market update. There's been a lot of stuff. Inflation, interest rates, the Fed, a lot of things that we're kind of seeing, wanting to kind of keep everybody safe and ultimately in the right direction as far as their investments go. So, stay tuned for that, and we'll give you a little bit of insight on how we're looking at the market next week.
All right.
Thanks, everybody.